Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kinsale Capital Group Inc. Annual Report. Kinsale Capital Group Inc. offers a wide range of insurance products to both commercial and personal clients across the United States. The company's commercial lines include various types of insurance such as property, casualty, construction, allied health, and professional liability, among others. These offerings cater to specific industries like energy, life sciences, entertainment, and agriculture. In addition to its commercial lines, Kinsale Capital Group also provides personal lines insurance products, including high-value homeowners and personal insurance policies. The company's extensive network of independent insurance brokers allows it to sell its insurance products in all 50 states, the District of Columbia, Puerto Rico, and the U.S. Virgin Islands. The company's diverse range of services includes commercial auto, excess professional, environmental, inland marine, healthcare, management liability, public entity, aviation, ocean marine, agribusiness, product recall, and railroad insurance. This comprehensive list of offerings positions Kinsale Capital Group as a one-stop shop for all insurance needs, making it an attractive option for businesses and individuals alike. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of Kinsale Capital Group, Inc. has likely dropped in the past year due to various market and economic factors. One possible reason is a decline in investor confidence, which can be triggered by negative news or announcements about the company's performance or financial health. This can lead to a decrease in demand for the stock, causing its price to drop. Another potential cause of a declining stock price is changes in industry trends or market conditions that negatively impact the company's operations and revenue. For example, if Kinsale Capital Group operates in an industry that is experiencing a downturn or disruption, it may struggle to maintain its sales and profitability, leading to a decline in its stock price. Additionally, external factors such as economic recessions, interest rate changes, or regulatory issues can also contribute to a decrease in the company's stock price. These events can create uncertainty and volatility in the market, causing investors to become risk-averse and sell their shares, further driving down the stock price. In conclusion, the decline of Kinsale Capital Group's stock price is likely due to a combination of internal and external factors that have negatively impacted investor confidence and the company's financial performance. Kinsale Capital Group, Inc. maintains a market capitalization of $9 billion, broadly in line with the industry peer group. Kinsale Capital Group, Inc. trades at a higher price-to-earnings ratio of 17 times and a higher price-to-book ratio of 4.39 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, the adoption of reinsurance reforms, accurate risk assessment and pricing, collection of premiums from policyholders and brokers, investment income, and profitable growth are significant contributors to revenue expansion. Additionally, factors such as an increase in fair value of the company's investment portfolio, share repurchases, and growth in business also contribute to revenue growth. On the decline side, inability to obtain reinsurance at reasonable prices or on terms that adequately protect us catastrophes and severe weather conditions, pandemics and public health crises, global climate change, economic conditions, market volatility, and changes in international trade regulation are major drivers of revenue decline. Furthermore, factors such as competition from other specialty insurance companies, deregulation of commercial insurance lines, shifts in the way E&S insurance is marketed, and lower volume of stock option exercises also contribute to revenue decline. It's worth noting that some factors may have both positive and negative impacts depending on the context, but overall these drivers provide a comprehensive understanding of the key influences on revenue growth or decline. The net income of the company experienced significant fluctuations between 2024 and 2025. In 2025, the net income decreased by -15.8% compared to the previous year. However, in a separate instance, it is mentioned that the net income increased by $88.8 million, 21.4%, from $414.8 million to $503.6 million. The reasons for this decrease are varied and include inadequate reserves for claims, increased cost of evaluating potential claims, and potential losses exceeding established reserves. Additionally, the company faced increased risk exposure and potential losses due to adverse economic factors, such as recession, inflation, and high unemployment. The frequency and severity of claims also increased, leading to a decrease in net income. Profit margins also experienced a decline due to reduced market share and inadequate reserves for claims. The combined ratio was 75.9% for the year ended December 31, 2025, indicating that the company's expenses exceeded its premiums by nearly 76%. This suggests that the company is struggling to maintain profitability amidst increasing costs and decreasing revenue. The reasons for the decline in profit margins are similar to those affecting net income, including inadequate reserves for claims, increased cost of evaluating potential claims, and potential losses exceeding established reserves. The company's reliance on reinsurance coverage also led to gaps in protection for certain risks, further exacerbating its financial struggles. The company's financial performance has shown significant improvement in its ability to generate operating cash flow. According to the data on page 53, the operating cash flow increased from $201,011 in 2024 to $255,416 in 2025, indicating a positive trend. This increase is further supported by the net cash provided by operating activities, which reached $1,043,738 in 2025. This substantial amount of cash generated from operations suggests that the company's business model is efficient and effective in producing revenue. As a result, the company is now generating positive operating cash flow, indicating a strong financial position. The company's debt level has undergone significant changes over the past few years. On one hand, there are instances where the total debt level has increased substantially, such as from $4.1 billion to $5.2 billion on page 14, and from $184,122 in 2024 to $224,397 in 2025 on pages 79, 121, and 136. This indicates a notable rise in debt levels. However, interest expenses have shown varying trends. In some cases, they have remained relatively stable or decreased, such as the 5.1% decrease from 2024 to 2025 mentioned on page 49. On the other hand, there are instances where interest expenses have increased, like from $10,134 in 2024 to $10,646 in 2025 on pages 63 and 80. Overall, while debt levels have fluctuated significantly, interest expenses have remained relatively stable or decreased in some cases. The company's outlook and strategy are centered around growth, risk management, and financial stability. Management is focused on expanding its underwriting divisions, particularly in key lines of business, to drive revenue growth and improve profitability. To achieve this, the company has implemented a risk management strategy that includes investing in high credit quality issuers, limiting credit exposure, and managing interest rate risk. In addition to growing its core business, the company is also prioritizing transparency and accuracy in its investment portfolio management. This suggests a cautious approach to managing risk and ensuring the reasonableness of investment values. Management expects sufficient liquidity to meet operating cash needs for the next 12 months and plans to use available funds to support premium growth, reduce reliance on reinsurance, pay dividends and taxes, repurchase shares, and other business purposes. Overall, the company's strategy is focused on balancing growth with risk management and financial stability, while also prioritizing transparency and accuracy in its investment portfolio management. This approach suggests a commitment to long-term sustainability and responsible financial management. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends, which is a common practice among publicly traded companies. The company's decision to pay dividends demonstrates its commitment to sharing profits with its investors and providing them with a return on their investment. In addition to paying dividends, the company has also taken steps to reduce the number of outstanding shares through share buybacks. This strategy allows the company to increase earnings per share and improve its financial performance without having to issue new equity. By buying back shares, the company is able to concentrate ownership in the hands of existing shareholders, which can lead to increased loyalty and retention. Overall, the company's decision to pay dividends and buy back shares reflects its focus on creating value for its shareholders and providing them with a stake in the company's success. That concludes the financial summary for Kinsale Capital Group Inc. Feel free to comment below, and I will be happy to answer them when possible.